When most people think about investing, they think about stocks. They think about companies, share prices, portfolios going up and down with the market. Stocks get all the attention. Stocks get all the headlines. But there is another type of investment that quietly sits in the background of some of the most successful portfolios in the world. An investment that does not make the news when it has a great day, does not get talked about at dinner parties, and does not trend on social media. That investment is bonds, and if you have never really understood what a bond is, how it works, or why it matters, you are not alone. Bonds are one of the most misunderstood and underappreciated tools in personal finance. Most beginners ignore them completely, and many of them pay for that mistake later. Today, we are going to fix that. By the end of this video, you will understand exactly what bonds are, how they work, why they matter, and how they fit into a smart investment strategy alongside everything else we have covered in this series so far. If you are new here, welcome. This channel is all about helping everyday people build real wealth starting from just $500. Every video breaks down one key financial concept in plain, simple language with no jargon and no assumptions about what you already know. Subscribe and hit the notification bell so you never miss an upload. And if this content is adding value to your financial education, please hit the like button. It helps this channel reach more people who need it. Let us get into it. The best way to understand bonds is to start with a simple real-world analogy. Imagine your friend is starting a business. They need $1,000 to get it off the ground, but they do not have the cash right now. They come to you and ask if you can lend them the money. You agree, but you set some terms. You will lend them $1,000 today. They will pay you back the full $1,000 in 5 years, and in the meantime, they will pay you $50 every year just for letting them use your money. That is essentially what a bond is, except instead of your friend, the borrower is a government or a large corporation, and instead of a private agreement between two people, it is a formal financial instrument that can be bought and sold on the open market. When you buy a bond, you are lending money to the issuer of that bond. They agree to pay you a fixed amount of interest at regular intervals, usually every 6 months or every year, and at the end of the agreed period, called the maturity date, they pay back your original loan in full. Simple. You lend money, you get paid interest, you get your money back at the end. Before we go further, let us lock in the key vocabulary around bonds so everything makes sense as we go deeper. The first term is principal. This is the amount of money you lend when you buy a bond. It is also sometimes called the face value or par value. This is the amount you get back when the bond matures. The second term is coupon. This is the interest payment you receive from the bond issuer. It is called a coupon because historically bond certificates had physical coupons attached to them that investors would clip and redeem for their interest payments. Today it is all digital, but the name stuck. The coupon is usually expressed as a percentage of the principal. A bond with a 5% coupon and a $1,000 principal pays $50 per year in interest. The third term is maturity date. This is the date when the bond expires and the issuer pays back your principal. Bonds can have maturity dates ranging from a few months to 30 years or more. Short-term bonds mature in 1 to 3 years, medium-term bonds in 3 to 10 years, long-term bonds in 10 years or beyond. The fourth term is yield. This is the actual return you are getting on your bond investment, taking into account the price you paid for it. Yield and coupon sound similar, but they are not always the same thing, and we will explain why in a moment. The fifth term is credit rating. This is a score given to a bond issuer by rating agencies that reflects how likely they are to actually pay back what they owe. Higher-rated bonds are considered safer. Lower-rated bonds carry more risk but typically offer higher interest rates to compensate. Who issues bonds? Bonds are issued by 3 main types of borrowers. The first is governments. When a national government needs to raise money to fund public services, infrastructure, or manage its budget, it can issue bonds to the public. These are called government bonds. In the United States, they are called treasury bonds or T-bonds. In the United Kingdom, they are called gilts. Government bonds from stable, developed countries are generally considered among the safest investments in the world because the likelihood of a major government defaulting on its debt is extremely low. The second is municipalities. Local governments, cities, and regional authorities also issue bonds to fund things like schools, roads, and public buildings. These are called municipal bonds. In many countries, the interest earned on municipal bonds receives favorable tax treatment, making them attractive to certain investors. The third is corporations. Large companies issue bonds when they want to raise capital without selling more shares. These are called corporate bonds. Corporate bonds typically offer higher interest rates than government bonds because corporations carry more risk than governments. A company can go bankrupt. A stable national government almost never does. Why do bond prices and yields move in opposite directions? This is the part of bonds that confuses almost every beginner. But once you understand it, it clicks permanently. Here is the key concept. When bond prices go up, yields go down. When bond prices go down, yields go up. They move in opposite directions. Always. Let us walk through why with a simple example. You buy a bond for $1,000 with a 5% coupon. That means you receive $50 per year in interest. Your yield is 5%. Now imagine interest rates in the broader economy rise. New bonds being issued now offer a 6% coupon. Suddenly, your 5% bond looks less attractive by comparison. Nobody wants to pay $1,000 for your bond when they can get a new one that pays more. So the price of your bond drops. Let us say it drops to $900, but the coupon stays fixed at $50 per year. Now someone buying your bond for $900 is still getting $50 per year, which is actually a yield of about 5.6% on their $900 investment. The lower price has pushed the yield up closer to the current market rate. Now flip it. Interest rates fall. New bonds only offer a 3% coupon. Your 5% bond suddenly looks very attractive. Investors are willing to pay more than $1,000 for it. The price rises. But as the price rises, the yield falls because the $50 annual payment is now a smaller percentage of the higher price. This is why bond investors pay close attention to interest rate movements. Rising interest rates push bond prices down. Falling interest rates push bond prices up. You do not need to trade on this knowledge as a beginner, but understanding this relationship helps you understand why your bond investments move the way they do. Bonds versus stocks. What is the difference? Now that we understand both, let us compare bonds and stocks directly because this comparison is at the heart of how most investment portfolios are built. Stocks represent ownership. When you buy a stock, you own a piece of a company. Your returns are tied to how well that company performs. There is no fixed payment, no guaranteed return, and no set end date. The upside can be enormous. The downside can be a total loss. Bonds represent debt. When you buy a bond, you are a lender, not an owner. Your returns are fixed and predictable, the coupon payments and the return of principal at maturity. The upside is limited to those agreed payments. The downside is also limited as long as the issuer does not default. Stocks tend to offer higher returns over long periods of time, but with much higher volatility. Bonds tend to offer lower returns, but with much more stability and predictability. Here is the critical insight. Stocks and bonds often move in opposite directions. When the stock market falls sharply, investors often move money into bonds, which are seen as safe havens. This drives bond prices up. When the stock market is booming, investors often move money out of bonds and into stocks chasing higher returns. This can push bond prices down. This inverse relationship is exactly why holding both stocks and bonds in a portfolio can smooth out your overall returns. When your stocks are having a bad year, your bonds may be holding steady or even gaining. This is the concept of diversification in action across different asset classes, not just within stocks. Types of bonds. Just like ETFs, not all bonds are the same. Here is a quick overview of the main categories. Government bonds are issued by national governments and are considered the safest type of bond. They offer lower interest rates because the risk is low. These are appropriate for the most conservative portion of a portfolio. Corporate bonds are issued by companies. They offer higher interest rates than government bonds but carry more risk. Investment-grade corporate bonds are issued by financially strong companies and are relatively safe. High-yield bonds, sometimes called junk bonds, are issued by companies with lower credit ratings and offer very high interest rates to compensate for the significantly higher risk of default. Municipal bonds are issued by local governments, often tax-advantaged depending on your country and situation. Treasury inflation-protected securities, sometimes called TIPS, are a special type of government bond where the principal adjusts with inflation. This means your investment keeps pace with the rising cost of living, making TIPS useful as an inflation hedge. Bond ETFs are funds that hold a collection of bonds, just like stock ETFs hold a collection of stocks. Bond ETFs offer instant diversification across many different bonds through a single purchase, making them ideal for beginners who want bond exposure without having to buy individual bonds. So how does all of this apply to someone starting with $500? The honest answer is that at $500, bonds may not be the most exciting or highest impact part of your portfolio. Stocks and ETFs will likely drive most of your early growth. But understanding bonds and including even a small allocation to them builds good habits and teaches you how a balanced portfolio actually functions. A common starting framework that many financial educators reference is the idea of adjusting your bond allocation based on your age and risk tolerance. A rough rule of thumb that has been used for decades is to hold a percentage of bonds roughly equal to your age. So a 25-year-old might hold 25% bonds and 75% stocks. A 50-year-old might hold 50% of each. This is a very simplified guideline, and there are many different perspectives on the right allocation. But the underlying logic is sound. When you are young, you have decades for the market to recover from downturns, so you can afford more risk. As you get older and closer to needing your money, stability becomes more important than growth. For a beginner with $500, a small allocation to a bond ETF, perhaps 10 to 20%, gives you exposure to this asset class and starts building the diversified foundation that serious investors maintain throughout their lives. No investment is without risk, and bonds are no exception. Let us be clear about the risks so you go in with eyes open. Interest rate risk. As we covered, when interest rates rise, existing bond prices fall. If you need to sell your bond before maturity and rates have risen since you bought it, you may get less than you paid. Credit risk. If the bond issuer, a company, or even a government runs into financial trouble and cannot make its payments, you may not receive your coupon payments or even your principal back. This is called default. It is rare for high-quality government bonds, but very real for lower-rated corporate bonds. Inflation risk. If inflation rises faster than your bond's coupon rate, the real value of your interest payments is being eroded. You are earning 3% interest, but inflation is running at 5%, meaning your purchasing power is actually declining. Liquidity risk. Some bonds are harder to buy and sell quickly than others. If you need your money fast and the bond market for your particular bond is not active, you may struggle to find a buyer at a fair price. These risks are manageable, especially for beginners sticking to high-quality government bond ETFs. But knowing they exist helps you make informed decisions rather than assuming bonds are completely safe simply because they are more stable than stocks. Let us bring everything together. A bond is essentially a loan you make to a government or corporation in exchange for regular interest payments and the return of your principal at maturity. The key terms are principal, coupon, maturity date, yield, and credit rating. Bond prices and yields move in opposite directions. Rising interest rates push bond prices down, falling rates push them up. Stocks represent ownership and offer higher potential returns with higher risk. Bonds represent debt and offer lower but more predictable returns with lower risk. Bonds and stocks often move in opposite directions, which is why holding both can stabilize a portfolio over time. The main types are government bonds, corporate bonds, municipal bonds, inflation-protected securities, and bond ETFs. For beginners, a small allocation to a bond ETF is an accessible and effective way to add bond exposure to a $500 portfolio. The main risks are interest rate risk, credit risk, inflation risk, and liquidity risk. Bonds might not be the most exciting topic in personal finance. They do not have the same thrill as watching a stock double in value, but they are a foundational piece of how serious, long-term wealth is built and protected. Understanding bonds makes you a more complete investor. It means you can build a portfolio that does not just grow in good times, but holds up in bad ones too. If this video helped you finally make sense of bonds, please hit the like button. It takes 1 second and it genuinely helps this channel reach more people who are on the same learning journey you are on. Subscribe if you have not already, because the next video in this series covers the first portfolio update. We check in on how a $500 portfolio built on the principles from this series would realistically be performing and what the early numbers actually tell us. Drop a comment below and let me know, did bonds make sense to you before this video, or was this brand new information? Your feedback shapes what we cover next. Every concept you learn brings you one step closer to making genuinely informed decisions with your money, and that is exactly what this channel is here to help you do. See you in the next one.